I want you to imagine a country, right, that has just essentially cracked the code on the future of transportation. I mean, they are building the most advanced electric and hybrid vehicles on Earth.
Oh, yeah. Massive, hyper-efficient factories, rapidly expanding software capabilities. It's
Yeah.
incredible.
Right. And batteries that constantly push the limits of range. So there is this absolute abundance of incredible vehicles just rolling off the assembly lines. But if you walk into a showroom right there at home, you will see something completely baffling.
Yeah, you really will.
The buyers are just standing there, wallets in hand, staring at an overflowing buffet of cutting-edge cars, and they're simply, well, they're freezing.
It is a massive paradox, honestly. You have this peak industrial capability colliding head-on with sudden, widespread consumer paralysis.
Yeah.
And what makes it so fascinating is that it isn't a lack of interest in the cars themselves. The vehicles are spectacular. The paralysis comes from a much more complex psychological shift.
Which is exactly why we're here. Welcome to today's analysis. We are unpacking a massive global puzzle currently unfolding in China's auto market.
Absolutely.
For those of you listening, whether you're, trying to figure out where the global economy is heading or just wondering why car prices are acting so strangely lately, this matters to you.
It really does.
Our mission in today's analysis is to explore why these specific car buyers are waiting, how this domestic hesitation could completely reshape global car prices, and why a market flooded with attractive products can actually destroy demand.
Because if the world's largest auto market has a waiting problem, the shockwaves aren't going to stay contained, right?
Yeah.
The pressure will be felt in every single manufacturing hub and dealership around the world.
Exactly.
The data we're looking at reveals this isn't just like a localized sales slump or a bad quarter. We are witnessing a fundamental rewiring of consumer psychology regarding what a car actually is.
Okay, let's unpack this, because what is happening inside the minds of these consumers completely flips the traditional car buying script.
Oh, 100%.
If you watch how people behave in showrooms right now, you realize something crazy. Buying a car in China is no longer a product decision. I mean, think about the last time you bought a vehicle. You probably compared the price, the fuel, the brand.
Right, you pick the one that fit your life.
Yeah. But for these buyers, it has morphed entirely into a timing decision.
The consumer is looking at a brand new, highly advanced vehicle. And instead of asking, is this a good car? They are looking at the pace of innovation and asking, will this exact model be updated in 6 months?
Right, like, will a competitor slash their prices by 20% next quarter? Is a bigger battery or a smarter cabin going to arrive before I even finish paying off this loan?
Exactly. And when the answer to those questions is a very realistic yes, waiting becomes the most rational financial defense a household can deploy.
Yeah, that makes sense.
A new car is no longer just a purchase. It is a forecast about depreciation. You aren't just buying transportation anymore. You're taking a massive gamble on the residual value of a piece of rapidly evolving tech.
Okay, so there's this analogy from the data that I think perfectly captures this feeling. Imagine you are booking a stay at a luxury hotel, right?
Okay.
And this hotel adds new, better rooms every single season, and they lower their nightly rates every single weekend to attract more guests. The only customers love it at first.
Sure, bargains everywhere.
Right. But very quickly they realize that booking early is a trap. The longer they hold out, the better the deal gets. But I want to push back on this premise for a second.
Go for it.
If cars are getting cheaper and objectively better at this rapid pace, shouldn't people be rushing the doors to buy? I mean, why does abundance suddenly make the consumer freeze?
Well, it comes down to the fundamental difference between a disposable good and an asset. Like if a television drops in price by 50%, you might be annoyed you bought early, but you just keep watching the TV.
Yeah, true.
A car, however, holds a trade-in value that households rely on to fund their next purchase.
Yeah.
When automakers constantly slash prices on new models, the used car values for the models already on the road fall off a cliff.
Oh, wow. So they're terrified of losing that equity.
Exactly. A buyer might look at a new car today and think the monthly payment is great, but they are terrified about what that vehicle will be worth when they try to trade it in 3 years from now.
Which means the safest financial move is just to keep your old car and sit on your hands.
Effectively, yes. The market has basically lost the power to set prices because buyers simply don't trust that today's sensible price will hold until tomorrow.
So what does this all mean? Are these companies just stuck in a race to the bottom, or is there a way out? Because from what you were describing, slapping massive discounts on the hood actually makes the problem worse.
It does. If we connect this to the bigger picture, we have to look at how the market is fracturing into distinct economic zones. You have the upper end, the middle market, and the lower end.
And they all react differently to this depreciation fear, right?
Exactly. At the upper end, you have the premium buyers. They are driven by high-end software, extreme performance, luxury brand experience. That segment can absorb some of this differentiation.
Because they have the money to not care as much.
Right, they're paying for the prestige of having the newest tech first. But the middle market, that is the most vital segment.
The everyday family buyers.
Yes, they are focused on practical range, family utility, and financing. This is where ordinary household confidence matters the most. If they are paralyzed by the fear of negative equity, the whole system stalls.
And I imagine the lower end is even more vulnerable.
Absolutely. At the lower end, affordability is everything. They are the most vulnerable to any economic delays or price fluctuations.
Which means automakers cannot rely on the old playbook of just discounting everything.
Right. The insights draw a sharp line here between a sales recovery and a value recovery. A sales recovery is a sugar rush. You buy with deep discounts, you get a spike in traffic, and then you are right back where you started.
But with angrier past customers whose trade-in values you just ruined.
Precisely. A value recovery, though, is earned through stable pricing, reliable service, and giving the consumer confidence. To survive, companies are facing 4 massive pressures.
Okay, what are they?
First, cost control to survive the price war. Second, product speed moving at software speed rather than hardware speed. Third, ecosystem strength. And fourth, residual value credibility.
I want to touch on that ecosystem piece because the data highlighted things like charging networks, proprietary insurance, and trade-ins. Why does a car manufacturer suddenly need to care about my insurance?
Because controlling the ecosystem supports the vehicle long term. If an automaker offers in-house insurance based on driving data, they lower the total cost of ownership. Winning the initial sale doesn't matter if the buyer doesn't believe the sale will still make sense next year.
They're basically shifting from treating a car like a one-time product to managing it as a long-term financial relationship.
Exactly that.
Here's where it gets really interesting. This pressure to maintain this relationship and push out products at a blistering pace, it doesn't happen in a vacuum. It ripples violently backward through the entire supply chain.
Oh, the pressure on the supply chain is immense. Volume is actually a highly misleading metric right now.
Really? You'd think high volume would be great for suppliers.
You'd think so, but lower prices force battery producers, electronics makers, and logistics companies to do more for less. A supplier can win a huge, headline-grabbing contract but barely cover their cost of capital.
They are running a marathon at sprint speed just to stand still. I mean, we are essentially watching a 2-ton highway speed iPhone being built.
That's a great way to put it.
But how on earth does a legacy automaker who is used to spending like 5 years perfectly engineering a door handle compete with a market demanding smartphone-level speed?
What's fascinating here is that they often can't. This compression creates an intense auto treadmill. Cars are now refreshing closer to consumer electronics than traditional autos.
Which forces legacy automakers globally to just abandon their old strengths, right? Like their long validation cycles.
Yes, for decades, deliberate pacing was their moat. Now it's a liability. The real test for the industry is whether they can sell more vehicles without making every single vehicle less valuable.
And that leads right into the aftermarket, doesn't it?
It does. Extracting value from cars already on the road repairs, software services, certified used cars, is no longer a side story. It's essential for recurring revenue.
So let's look at the logical next step. If the domestic market is trapped in this brutal price war, factories have to look outward to survive. The domestic problem is now crossing borders.
Right. Exports act as a pressure release valve to keep factories busy, spread fixed costs, and protect supplier networks.
I try to imagine it like trying to outrun a storm by sailing directly into another one, because exporting just moves the problem to a different arena, and the global choke point is no longer making vehicles, it is market access.
Market access is an incredibly thorny issue. Tariffs are just one hurdle.
But let me ask you this. If they face all these tariffs and political pushback, can't they just build factories locally in these other countries and bypass the issue entirely? They have the money.
This raises an important question, because building locally sounds like a silver bullet, but the hidden costs are astronomical. True localization requires immense capital, new local supply chains for parts, local dealers.
Software compliance too, right? Data governance laws.
Yes, and political acceptance. There's a huge contrarian insight here. Weakness at home pushes Chinese car makers to be aggressive abroad. But the more successful they are abroad, the more political and regulatory resistance they face.
Success creates scrutiny. Turning export momentum into a durable local business takes immense trust. You can't buy that with just cheap battery prices.
Exactly. Which brings us to how this all resolves. The data outlines two paths, the bull case and the bear case.
Let's hear the bull case first.
In the bull case, we see a healthy recovery. Price competition. Well, there are 6 key things. First, retail demand. Don't just look at factory shipments, look at actual household registrations.
Right, because pushing cars onto a lot doesn't mean they're selling.
Exactly. Second, watch the depth of the discounting. Third, keep an eye on used car residual values as a real-time fear gauge.
If those stabilize, trust is returning.
Yes. Fourth, look at mainstream household demand. If everyday families are buying, the market is healing. Fifth, export profitability, not just volume.
Because shipping cars overseas only matters if you can actually turn a profit servicing them locally.
Exactly. And finally, the sixth thing, aftermarket prioritization. Are companies focusing on retention through software and services?
So to summarize all of this, China already knows how to build phenomenal, competitive vehicles. The ultimate test now is restoring confidence at home and trust abroad. Because the most valuable vehicle isn't the newest one, it's the one buyers believe is still worth owning tomorrow.
That is the perfect way to phrase it. Navigating the psychology of the modern consumer is the actual challenge now.
Which leaves me with one final provocative thought for you to ponder. If cars are becoming more like consumer electronics, where they depreciate wildly the moment a software update is announced, will the whole concept of car ownership eventually become obsolete?
Ooh, that's an interesting question.
Right. Like, are we heading toward a future where we just subscribe to a vehicle rather than ever taking on the massive risk of buying one? It is definitely something to think about the next time you look at a car's sticker price. Thank you so much for joining us for today's analysis. Keep questioning the systems beneath the headlines, and we will catch you next time.